Hi, this is Jeffrey Kerr, Kerr Financial Group. Today is Friday, October 3, 2025. So Washington, D.C. is shut down, but Wall Street's open and celebrating. Yesterday, stocks closed at an all-time high. It's the 30th record close this year. Rather amazing. Again, it is shut down and no jobs data. And everything the upheaval surrounding the federal government and stock market saying, hey, things are going okay, and we're going to keep moving higher. Now, there's another dynamic here that I think is pretty interesting. I saw this article in Barron's that talked about the shrinking number of publicly traded companies. Back in 1996. There was approximately 8,100 publicly traded companies in the U.S. At the end of 2024, that's down to 4,100, which is amazing. So the article attributes to, I know that part of this is the reason, increased regulations on both going public and being a publicly held company, as well as the opportunity to stay private either through lending and new lending and capital raising mechanics, private equity and like that. Also, when somebody wants to exit, now that private equity is a growing sector, that's an opportunity just to sell that way rather than going public. So an interesting dynamic is that, again, the number of stocks out there is a lot lower than it was a couple of decades ago, and money flowing into the market is a lot higher. So again, the kind of supply and demand, stock prices are going to move higher strictly just on that one projection. Now, the other thing I think was interesting, I saw this a Y charts estimate that there's over 4,100 ETFs. So the number of ETFs might be higher than the number of stocks. And especially if you got 4,100 stocks, the ETFs aren't buying some of the smaller companies of the 4,100 publicly traded companies. So again, the ETFs are buying the same things. And also, I think that the risk is that some of these ETFs are levered, 2-to-1, 3-to-1 to move. Some of them, I see some new ones for NVIDIA and 2 times the NVIDIA move, as well as, short ETFs too. But, the conclusion of all this, I think, is that this is, a very risky market with the structure of the way things are trading and like that. Doesn't mean it has to go down. And this has been a while. This is not like a new development in September of 2025. This has been going on for a while. So I think it's, again, that concentration, the ETFs all owning the same things. If some systemic or some problem happens to the economy or the markets, there's a reason to believe there's a lot of downside that could happen pretty quickly. So hopefully I didn't depress you for the weekend. Enjoy the weekend. We'll be back on Monday. Thank you. Goodbye.